Hi, my name is Elliot Gu. I'm the founder and editor of the Creating Wealth service. Now, you may or may not be aware of a troubling fact about gold and precious metals mining stocks. The average all-in sustaining cash cost, which is a measure of how much it costs a gold miner, a gold producer, to bring an ounce of gold to market and sustain their existing equipment and business. Now, this cost for the largest so-called senior gold mining firms all over the world has jumped from $808.80 an ounce of gold in 2019 to a whopping $1,216.80 an ounce in 2022. Think about that. In 2019, the average realized price of gold, the average amount of money they earned for every ounce of gold they sold for the same group of senior mining firms, large gold mining firms, was $1,418 an ounce compared to almost $1,800 an ounce last year. So that's a more than 26% increase. Yet because of soaring mining costs, their profit margin on ounces of gold produced last year in 2022 actually shrank to $575 an ounce in profit margin compared to $609 an ounce in 2019. That's right, inflation in mining costs means that a 26% plus jump in gold prices between 2019 and 2022 has not benefited most gold mining companies because their costs have risen faster, far faster over the last 3 years than the price of gold has risen. However, despite the surge in gold production costs over the past few years, there is still a way to buy gold for $425 an ounce. $425 an ounce. You can also mine an ounce of silver for a cost of $5 an ounce right now, even with the price of silver at more than $24 an ounce. And the average global silver producer, silver mining firm, facing all-in sustaining cash costs north of $11.80 an ounce of silver. And that's based on the names that have reported first quarter 2023 earnings this spring. In this short video, you'll discover exactly how this is possible through a widely overlooked corner of the precious metals industry. However, before I get into all that, let me back up and explain why I believe it's a great time to add to your exposure to precious metals via gold and silver and related stocks. And many of you are probably aware the price of gold has recently surged close to all-time highs and above $2,000 an ounce. Now here's a chart. This chart of gold prices since the end of 1999 reveals that the entire 10 plus years since the 2011 top, just under $2,000, appears to be a sort of base, what technicians might call a cup with handle formation. The consolidation that's formed over the past 3 years, which I've put in a rectangular box here on the chart, looks like a period of basing just under those highs of $2,000 plus. My view is that gold prices will make a new leg higher starting this year, as soon as this summer in my outlook, and that we'll see $3,000 an ounce at some point over the next 12 to 18 months. The timing for such a move is lining up right on schedule. You see, historically, gold and silver prices take off just as the US economy slips into recession. Now, this chart shows the change in the price of gold in percentage terms from the end of March 2000 through November 2002. This is 1 year before the start of the US recession in March 2001, through 1 year after the end of recession in November 2001. I've also labeled the Fed's last hike in this cycle, which came in May 2000, and the Fed's first cut, a surprise cut, in early January 2001. You can see that gold experienced a powerful 1 year rally following the start of recession in March 2001. Now, it's a common fallacy that gold prices benefit from a falling stock market. In this cycle, in 2000 to 2002, for example, the stock market peaked in March 2000. And the sell-off accelerated in the fall and winter of 2000 and into early 2001. However, gold prices followed the stock market lower initially before soaring when recession became reality. Now, one possible reason is that when the stock market sells off quickly, the first knee-jerk reaction is to raise cash by selling any liquid assets, including gold. Now, here's another example. Now, no two cycles are exactly alike, but they do rhyme. In the 2007 to 09 cycle, that was a Great Recession cycle, gold prices started to ramp higher just before the start of the US recession. Gold did see a significant correction through an intense phase of the stock market sell-off and the collapse of financials like Lehman Brothers between March and October 2008. However, following that pullback, gold soared to fresh all-time highs in 2009 and again in 2010, and it reached a major all-time high peak in the fall of 2011 at a price of over $1,900 an ounce. Now, at the beginning of this presentation, I promised I'd show you how you can buy or effectively mine an ounce of gold for $425 an ounce and or silver for $5 an ounce. You can do exactly that through a widely overlooked corner of the market, a group of so-called streaming companies. Let me explain. A streaming company negotiates long-term precious metals purchase agreements, or PMPAs, with large global mining companies. Now, to execute a PMPA, streaming firms typically pay an upfront cash payment to a mining firm in exchange for a share of the stream of gold and or silver produced from the mine over time. In addition to that upfront payment, these firms also pay the miner a contracted amount for every ounce of gold or silver mined and delivered to them under the terms of the PMPA. Now, the best way to illustrate is with an example. Now, global mining giant Vale operates a massive mine in Brazil. Now, this is a copper mine, not a gold or silver or platinum or any other precious metals mine. It's a copper mine. And this is typically, these PMPAs are executed on mines that are not primarily gold or silver mine. This mine, in fact, sits on the largest copper deposit ever discovered in Brazil. And it began operating a little over a decade ago in May 2012, producing some 12 million metric tons of copper per year. Over time, Vale, the operator of this mine, has expanded the mine to double output to 24 million metric tons per annum, with a third expansion starting up at the end of last year, 2022. While this is a copper mine, gold is found naturally occurring in the same ore as copper in this region. Back in 2013, one of these streaming companies signed a deal with Vale, providing the miner with an upfront payment of about $3.06 billion US in exchange for 75% of all ounces of gold produced from the project. In addition to that upfront payment, the contract calls for the streamer to pay Vale $420 for every ounce of gold it delivers under the terms of the PMPA deal. That's a $420 payment for an ounce of gold currently worth over $2,000. The PMPA also provides Vale with additional incentive payments as it expands this mine, because that not only means more copper production, it means more gold production. Of course, the higher the potential throughput at the project, the higher the streamer's cut of gold produced. Streaming deals of this nature offer advantages to both the miner and the streaming firm. Now, from the miner's standpoint, they're selling ancillary production. Again, this is a copper mine, not a gold mine, from a mine in exchange for cash, which can be used to help fund the immense capital spending required to bring a new mining project into development. And of course, the streaming company benefits from gold production acquired at a fixed cost, resulting in much higher profit margins on gold ounces sold than a traditional precious metals mining firm. Now, earlier on, I mentioned that even a large senior mining firm like Newmont or Kinross Gold, the cost of producing gold has gone parabolic in recent years. All-in sustaining cash costs measures the total cost of mining an ounce of gold, including sustaining capital spending, or CapEx, needed to maintain the mine and production, general and administrative costs, additional exploration costs, and environmental rehabilitation costs. Kinross Gold and Newmont are both large senior producers, and you can see that cost per ounce have been rising for both companies since 2021. This should come as little surprise since cost inflation has been a persistent problem for many industry groups over the past 2 or 3 years. Of course, even at these higher costs, many miners can earn a generous margin on their production, and higher gold prices will still benefit quality gold mining companies. However, compare that rising cost curve to a similar metric for one major streaming firm I recommend in my Creating Wealth service. Now, as you can see in this chart, the ongoing fees that this streaming company pays for each ounce of gold purchased under these PMPAs was still just $475 an ounce in Q4 2022. While under silver streaming arrangements, similar in nature, the company's cash costs were $5 an ounce. In Q4 2022, the average price this firm realized from gold sales was $17.25 an ounce. And for silver, it was $21.52 an ounce. That's a 72% cash profit margin for gold and a 77% cash profit margin for silver. And there's more to like with this name. This company currently has streaming deals covering 20 operating mines around the world and 12 development projects, which represent mines that have yet to start production, but will do in the next few years. In just the past 2 years alone, this company has signed 9 new deals that are expected to generate average gold equivalent ounces of production of 154,000 ounces per year. Now, a gold equivalent ounce is a means of converting streams of silver, platinum, and other precious metals into gold ounces. Now, in this case, the company is using a conversion factor of $1,850 an ounce for gold, $24 for silver, and $1,100 for platinum. The result of all these new streaming deals and the ramp up in production from projects like Vale's mine in Brazil, management is looking for major upside to production. In 2022, this streamer purchased and sold 620,000 gold equivalent ounces, including 287,000 ounces of gold, 24 million ounces of silver, and 31,300 GEOs of other metals. However, on average, over the next 5 years, the company expects annual GEO production of 810,000 ounces, and over the next decade, 850,000 GEO ounces. Listen, since I just recommended this particular gold streaming company to members of my Creating Wealth service, my policy is not to reveal the name and symbol of this stock as part of a complimentary video like this one. It just wouldn't be fair to paid in full readers of the service. However, I will rush you the details of this precious metals streaming recommendation and all other recommendations I'm making in Creating Wealth right now, today, with a risk-free trial subscription to the service, the Creating Wealth service, that's available by clicking the link adjacent to this video. There's no risk or obligation associated with your trial subscription to Creating Wealth. Sign up today and try the service for the next month. Read my frequent issues, flash alerts covering new recommendations, and market updates. Even attend my monthly Q&A online chat with readers scheduled for May 30th this month. And only then decide if you don't believe Creating Wealth is worth every dime of the subscription cost. Simply call or email us to cancel your trial membership and receive a full refund of the subscription price. And after 30 days, should you decide that Creating Wealth no longer meets your needs for any reason whatsoever, just call or email us for a prorated refund of your remaining unused subscription term. Click the button adjacent to this video or call our subscription manager, Sherry, toll-free at 1-877-302-0749. That's 1-877-302-0749. Click the button adjacent to this video or give us a call on that toll-free line to start your risk-free trial today. Thanks again for listening. I hope to greet many of you as new risk-free trial members of the Creating Wealth service here in just the next few minutes. Thanks again.